Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody. I'm very excited for today's conversation with Anil, who is a fantastic payments entrepreneur and fintech entrepreneur and brings just a wealth of experience building companies that have been very successful, as well as, I'm going to say, icon in the fintech ecosystem space with Money2020 and Fintech Meetup. So I'm really excited for our conversation, especially focusing around his journey around payments entrepreneurship, and then more broadly around the evolution of the fintech space and the fintech community. So welcome to the podcast.
Thanks so much for having me, Lex.
My pleasure. So start us off with your entrepreneurial journey and how you got pulled into the payments world and the insights that you saw. Just let's anchor in that discovery moment.
Sure. People back in the late 90s and early 2000s that got into fintech in those days generally described their, entry into payments and fintech as they kind of stumbled into it. And I think that's true of my story. So I remember the holiday season of 1998. I was a lawyer. I had an assistant, and it was time to get her something for the holidays. And my plan was to go out, buy a gift card from Bloomingdale's for her. And I didn't have time to do that, of course. Back-to-back phone calls were true back then as well. And so I gave her an envelope with some cash in it, and I told her that I'd meant to get her something more thoughtful in the form of a gift card. And she said, I'm glad you didn't, when I told her it was going to be for Bloomingdale's, because she said, I think it's overpriced there. So that was kind of the genesis of an idea of a secondary market for gift cards. Kind of two things were happening at that point. The first was everyone was looking for a .com concept to bring to market. It was the rage. And for people who wanted to be entrepreneurs, the way I did, it seemed like a great entry point. The second was that, right at around the late 90s, there'd been a migration from paper-based gift certificates to gift cards. And so that convergence kind of resulted in this idea of this secondary market for gift cards. And it wasn't long in exploring that concept that the idea evolved into, well, what about a gift card that could be used anywhere because, it's a Visa or MasterCard card. And over time, as that was iterated, it really evolved more into, these payment systems are the most ubiquitous payment systems in the world. There's got to be more applications to them. Why don't we explore that? That's why I call it stumbling into the industry. Today, people have very specific concepts around particular problems they want to solve or gaps in the financial services ecosystem that they want to address. For us, it was kind of this journey of realizing that there was a lot of utility to these networks and they were being underutilized.
How clear was it, or how murky was it, that payments and the internet, besides being just emotionally attractive, to be an entrepreneur and take a shot and have a chance on building something new, what did it look like, the sort of intersection of payments and the web at the time? Sort of like, what did the potential feel like to you?
It's an interesting question. I think, there was my particular experience, and then let me answer it generally. I think generally there were some areas that were obvious, great intersections as e-commerce was taking off. Payments that facilitated e-commerce seemed more obvious. These are the days of the founding of PayPal. And creating payment capability for marketplaces like eBay. I would say in the case of Clarity Payment Solutions, which was the company I co-founded, it was a lot less clear because what we were doing was not on the acquiring side where there was a clear need, it was on the issuing side. And on the issuing side, the question really became, well, what are the applications? What exactly are people going to use, issuing processing for when it comes to intersecting with the internet?
Can I pause you just for definitions of acquiring, issuing, processing? What are these things?
Sure. So acquiring processing, the easiest way to think about it is That is a merchant or retailer accepting a payment. How do they do that? How do they get money basically in? It could be through a payment network, traditional one, or some other method. Issuing processing is it's kind of the other side of the transaction, where that's where your balance is stored. That's where you make a payment from. And so issuing processing generally refers to more of the cardholder or consumer side of the transaction, where they have a form factor of some kind to make a payment, and then they interact with the acquiring side to facilitate that payment. So they're two really distinct sides of the transaction.
Yep, absolutely. Okay, moving on.
What we knew, I guess, was that there had to be applications for these payment networks outside of their traditional uses for consumer lending and deposit access. So traditional credit cards and bank accounts. And that there had to be utility for these payment networks outside of being used pretty much solely by financial institutions of one kind or another. Could be a monoline credit card issuer or a traditional financial institution. And so those were the areas we really started exploring. We started, just like anybody did, frankly, back then, as a B2C play, where for doing certain promotional activities or interacting with websites, we would reward you in the form of cash loaded onto a virtual Visa account number. The bottom dropped out of .com companies pretty early on in our history. So we were founded late 99, early 2000. March 2000 is when most of these companies started really suffering some pain, and we had raised money late, so we were sitting on a pile of cash. Our first round was 6 million, and we hadn't spent it on consumer marketing. So it gave us runway to do a pivot and move to B2B. So in that environment, we started exploring what are all the different use cases. In many cases, those were people that approached us. We worked with the payment networks. We worked with Visa and MasterCard. When people were contacting them and saying, well, can you do this and can you do that? They had to find technology platforms that they could send those inquiries to that were able to do the things those people wanted to do. And we happened to end up being one of those platforms that had greater flexibility and capabilities. So we started getting an inflow of different use cases. Just to share a few examples with you, we were the processor behind the Rush card for Russell Simmons, for example. That was a product targeted largely to the unbanked African American community, with the credibility of Russell Simmons behind it and his reach. And the proposition was to go out to people that didn't have traditional credit cards, but still wanted to pay with a card. So we had to do a number of things. I remember one of them was we had to find a way to load these cards with cash. So we did an integration into MoneyGram, and pretty quickly we became MoneyGram's largest New York area client, doing offline loads onto Rush cards. So that's one example. Another example was doing cards that were given out by physicians to patients so that they could get sample packages of pharmaceuticals at the pharmacy. So those physicians didn't have to hold on to, and store these sample packages. There's safety benefits to that, and there's also tracking and other benefits to that. So these type of use cases found their way to us. Every time they did, there was almost a new value chain, a new form of distribution. Back in 2001, in many cases, some of these were API clients. I think maybe a lot of your listeners would be surprised to hear that they were issuing processing APIs as early as 2001. But we were doing those. In other cases, obviously, it was more of an end-to-end solution. But we ended up doing a wide variety of different types of products. And that industry became known as the prepaid card industry, because most of the applications required funds to be prepaid. Even if it was just in-time funding, there was still a requirement that funds be available ahead of being accessed on the cards. So we did everything from incentives and consumer promotions. We did gift cards. We did a number of different types of virtual applications in the B2B context. And, the company grew pretty nicely. We ended up raising about 19 million in venture funding. And for a 2000 vintage company, I think we ended up doing pretty well because a lot of those businesses didn't survive.
Absolutely. It's interesting to hear the pioneering of what is now embedded finance, and 5 years ago was financial APIs, and now is open banking, and how much of the concepts rhyme and were often pioneered by companies like yours. It's also the journey from B2C, raising around to spend on customer acquisition, and then in a different market environment to pivot into working with existing pools of demand and enabling those pools of demand. I think that's also a really recognizable story. And I think that's happened with digital wealth companies. I think that's happened with digital lenders in many different ways. That cycle's repeated with blockchain finance companies. And so that, to me, that rings kind of very universal and very true. Also want to react to the narrative around kind of the frontier and going into populations or niches or taking on risks that are a place where the traditional banks or the card networks can't themselves go, or don't find kind of large enough. And I struggle with this sometimes myself too, in that there are these stories that we have in society about the underbanked, or about democratizing finance and giving access to our financial products. And we see, fantastic growth, for example, in Square's Cash App, and being able to reach underbanked communities through like hip hop influencers and so on. How do you feel that has changed? How do you feel that the thesis and the early markets that you were discovering for the first time, how do they echo today? Are these sort of permanent structural things that really they can't be solved by technology, or do you feel like that the underlying social acceptance of paytech and the increasing literacy with finance and technology solutions is changing engagement with financial instruments? Like, how would you reflect on those early markets where you were seeing success and where they're at today?
Yeah, it's interesting. I think it's a great question. And actually, your last point there, in terms of where we were seeing success, frankly, I think in a lot of areas where we didn't see success, we're seeing great success now. If I were to frame the market opportunity that I felt we were addressing, say, between the founding of Clarity in 2000 and the sale of TxVia, which we can talk about as well, in 2012. So call it that dozen-year period. I would say that most of what we were going after fell into this category of prepaid. There's a limited number of use cases. In fact, one of the biggest challenges was just finding enough scale opportunities. And we did place bets with early stage companies. One of our clients at TxVia, for example, was Simple, Josh and Shamir's company. And there were other products like that. We did a program for Susie Orman called the Approved Card. And we were also, the processor behind general purpose reloadable cards sold on J-Hooks by Blackhawk. We were doing incentive cards for American Express Incentive Services. We built probably about a 25 million revenue run rate business at TxVia, but it still felt that we were addressing very niche opportunities. I'd say towards the tail end of those years, that those opportunities expanded to include digital wallets, which is how ultimately TxVia was acquired by Google. But if I were to compare that market to today's market, I'd say it's different in a couple of respects. The first is the scale of opportunities, and the second is the scope of opportunities. And I think that has to do with a few broader generational, cultural, and technology shifts. Probably one of the biggest ones is an era of digitization defined by mobile. So if you really think about when did mobile really start to define tech companies, it was probably after the financial crisis. The smartphone was introduced in 2007. Pretty much right after that, we went into the Great Recession. I raised 55 million in venture funding during the recession 2008 to 2011, and it was a challenge. You could certainly do it, but money wasn't freely flowing into really any sector. And so it stunted the real runway that mobile might have had earlier on. But coming out of the financial crisis, that changed. These are the times when companies like Uber really were started and began to take off. And so we've had now close to a decade of consumer experience products and interaction with mobile. and frankly, an entire generation that's grown up with it. And so that has had a significant impact on the use cases and market opportunities that define the opportunity for issuing processing. So I think that was part of it. As I think more about generational shifts, I'd say maybe the more in the category of things like democratization of areas very well, for example, investing in the stock market. Frankly, I think crypto has a lot to do with it. And when you look at the widespread interest in crypto, particularly across generations, I think those have all had impacts, particularly on the wealth creation side, to democratization of everything, income equality, and other topics that are cause based and really driving factors. I think it's a culturally very different place. So when people think about money and they think about financial services, they're thinking way more broadly. And I think that creates opportunities for products. Initially in the sense of unbundling the traditional ways that those products were brought to market, and as those things got unbundled and different companies and people focused on how do I make this the best version of it that is possible. I think that opened up opportunities for issuing processing, and we're probably seeing the same thing as a lot of the industry tries to rebundle. There's a lot of debate about whether that's the right way to go, or will financial services be more embedded in everyday experiences, or will they kind of coalesce again into distinct organizations or products? But the reality is both the unbundling and any rebundling again present opportunity for issuing processing. And then there's obviously the pandemic. And I don't think that we can underestimate the implications long term of the pandemic on digital. It really is a K-shaped recovery, at least at this point, but it's had an impact on digital that there's no going back on. Years of increase in scaling there. And so even as there's pent up demand and people want to go back to obviously doing things in person, humans are very social creatures. That's not going to unwind the degree to which digital is just a greater part of everybody's lives because of the last 12 months. So I think that's going to be, has been, and is going to continue to be a driver. A couple other things I'd just throw out there as I'm kind of thinking all of this through in my head. I think credit is going to be another driver on the issuing side. A lot of where the historical focus has been, let's call it an evolution from prepaid to neo-banking. Some of the next phase that we're really beginning to see where companies have already come out is on the credit side. And it's both consumer credit and business credit. So I think there's a lot of runway there. I'm going to see a lot of innovation in that space as well.
Absolutely. A lot of strong, chunky ideas in there that I want to respond to and kind of pull apart a little bit. I think one key insight that reflects off what you describe is it's almost impossible to control your market timing for some of these larger platform shifts. And, you go along with the thesis that is right, which is digital money will live in people's computing devices and in their phones, and that's going to be the center of their life. And if you make that bet in 95 or in 99 or in 2004 or in 2010 or 2015 or 2021, you can get the vector completely right and just have very different outcomes. And you were a very early pioneer in trying to crowbar that opportunity open and getting really the market ready for continued evolution. And part of that is also there's often a discussion of, well, are crypto assets going to take over fiat assets? Are they going to replace traditional banking? And I think that reflects kind of a misunderstanding of how the different digital economies have evolved, where yes, you have the credit card rails, but now you also have the phone pay rails, and then you have Ant Financial on its own set of rails, and now you might have a crypto set of rails. And the question is, which economies do these payments experiences really power? And I think about this a lot because we're early in the crypto ecosystem to actually spend the assets that people hold. But that was also true for internet-based businesses in the 2000s, where, as you describe, it wasn't as clear or as obvious that most of us are shopping for toilet paper on the phone and getting it immediately the next day. And so this simultaneous growth of the technology base, the financial institutions and the instruments they provide, and then the appropriate economy that receives that form of payment, it's super difficult to time. And I've seen, at least in the UK and in London, contactless proximity payments through the phone has been a huge savior for business because you can't use cash anywhere. And I just remember how difficult it was to get contactless adopted in the United States. And you sometimes need these massive catalysts to shake people out of their behavioral traps. They're sort of like local Nash equilibrium for this is good enough and I don't want to change. So I want to re-anchor us a little bit into geeky fintech infrastructure part of the story. And maybe in thinking about your transition to TxVia and doing that company, can you talk a little bit about like who your counterparties were and what the infrastructure was at the time? Like, were you working with the card networks or at the banks? Like, where was the actual money? How did the thing tie together?
Yeah, happy to talk about that. Let me just react a little bit to some of the points you made. I think they're all great points. One I'd like to add is that, when it comes to timing, you're absolutely right. I think what that speaks to is that any type of innovation in any area of payments, banking, and financial services, you have to play the long game. And I think that probably one of the biggest mistakes we made at Clarity was that we were always in a rush to figure something out versus really understanding that in the end we're going to likely overestimate what we can achieve in the short term and underestimate what we can achieve in the long term, because eventually you need a lot of different things to converge to make the opportunity for your innovations real. So if you look at a lot of the companies that are out there, that they might look like they're overnight successes, but the realities are that on the issuing side, for example, the Galileos are 20-year-old companies. Marqeta's probably over 10 years or thereabouts. And so these are companies that have been doing many of the same things and growing into the timing, so to speak. And so I just wanted to mention that when it comes to some of these other rails, the mobile networks or blockchain, the only real way to know is to let these things play out, and along the way make all those iterations and changes that ensure you're relevant as the market opportunity is transpiring. And in some ways, that's kind of the story of the transition from Clarity, which was acquired by TSYS in 2004, to TxVia. So if I were to describe Clarity in the early days, we didn't even have our own account on file system. We were relying on a third-party system, and it was a core system that a bank had, and we had to integrate into it. And then eventually, when we built our own account on file system, where we were storing balances, we weren't direct endpoints into the network, so we had to sync with that core system at the bank. And then over time, eventually, we did become direct endpoints into the Visa and MasterCard networks. So in terms of the value chain, let's pick it up at that point where at Clarity, towards the end, we were direct endpoints into the Visa and MasterCard networks. We had their hardware in our data centers. We had the ability to create accounts, fund those accounts, either directly or, as I mentioned, through APIs. And then we had another key set of partners, probably the most important of which was an issuing bank. And so ultimately, we had to get access to a bank identification number to be able to issue cards. And under the rules and regulations of the networks, ultimately it's the bank that's behind issuing those card numbers, that sits with all the liability, does all the diligence on data and things like that of companies like Clarity. I would say in the Clarity days, it was still very early days for the deconstruction of the traditional value chain, where you had companies like us, newer processors. You had companies that were bringing products to market like Green Dot, that were more program managers. So the value chain was, issuing bank, processor, program manager, and a program manager could be B2B or B2C. One of the challenges that we found in the Clarity days was that we were trying to do so many different kinds of products with lots of different value chains, that every time something new was presented to us, we had to try and scale our platform differently, or we had to figure out how to add a new type of organization into that value chain. And even though it was a modern, architecture for the time, services-oriented architecture with different applications talking through a service bus, and it was very data-driven, but it was still very hard to constantly update and change that code base for new opportunities, and to make sure that anytime you made a change, not only did it work for the new things that you wanted to do, but it wasn't breaking anything else. And so the more data driven it became, the more brittle it became, and it gets back to that old saying in the payment space that it was like, working on the engine of a 747 mid-flight. So the transition to TxVia was really a transition in the fundamental approach to how to think about building technology for this kind of business where you have such complexity in the value chain and such diversity of the product set. And so TxVia was founded as a tech company, unlike Clarity, to solve a very specific problem, and that was, what is the best way to handle technology in this kind of environment? And so instead of building a single application to do all of these things, I would say, the heart of the difference of TxVia was that it was a platform builder instead of a platform. It was a source code development tool. We referred to it as platform as a service. But the basic premise was that we separated the business requirements from the technical implementation. And we did it using something called a model-driven architecture. Many of your listeners may be familiar with that, where basically we described requirements as workflows, data flows, call flows. Some of those were in pre-built libraries. We had simple tools that third parties could use, accessing an IDE, an integrated development environment, where they could use a very simple scripting language, for example, to add to the requirements. And then basically we would take these very visual requirements that have been described in these ways, and we would compile them directly to object code. And then the resulting platform could be hosted by us, could be hosted by our client. If they wanted it to do it that way, we even conceptualized the concept of an appliance where we would provide a hardware, software package if we were doing this internationally, for example. But the basic premise of the output here was that it was an Occam's razor approach, that each platform should do all of the things that it needs to do. But just as importantly, it shouldn't do any of the things that it doesn't need to do. So you take away the complexity that is inherent in these systems that isn't necessary. You make it simpler and easier to manage. You make it more scalable for that particular product. But then if you want to add things, you can add things by going back to this library of models and basically pick and choose. And it was very modular in nature. It worked unbelievably well. This was, after model-driven architecture had been used and didn't work well in a lot of environments. But the TxVia founding team consisted of the engineers from Clarity. So they knew what they were doing. They knew what they wanted to build and where the challenges were. So I would say that kind of the biggest difference between TxVia and Clarity was this technology difference. In terms of the market, we were really going after the same market. And we were still in that pre-2011 period of certainly of mobile, the businesses that mobile enabled. The gig economy was a big one. And I think that's been a very important vertical for issuing processing, both in terms of paying individuals in the gig economy, plus being a proxy for the purchases that they're making on behalf of consumers. So, pre that period and some of those trends we talked about earlier, TxVia was still going after kind of the same set of opportunities that Clarity was. I would say there definitely was an evolution. There was greater scale, but I would still generally describe it as being in the prepaid space. And as I mentioned earlier, with kind of wallets more towards the tail end, maybe more things than, for example, the O2O commerce space, where companies like Groupon were trying to connect online and offline behavior. And those were avenues that we were looking at as well.
Super interesting. You were ahead of the time in so many different ways. And I feel like the pitch for a low code environment and the focus on developers is so white hot today, and is also, very, very correct. This is a complicated space. And so one of the the distinction you made up front, I think, is worth kind of reiterating, especially in the context of where a lot of things have shifted to. So you had mentioned Galileo, which I think was acquired by SoFi. And, if you think about SoFi is a neobank, robo-advisor, digital lender, and so on, primarily a digital lender. but SoFi is the consumer's financial experience from that perspective. And then you've got other developer focused companies or other sort of e-commerce payments companies, whether it's Rapid or Checkout or Stripe, some of which are, again, very focused on the developer and enabling others to build stuff, but are doing it from the perspective of the merchant, where you're coming in and you're buying something. And so they need some version of a shopping cart, which has now become its own sort of almost full-fledged banking experience. And so that distinction to me, I think, is really important to kind of understand where you were playing. I kind of want to take the thread about enablement and especially developers. How did you think about getting people to engage and build? And I'm trying to ask this question in the context of what's happened in the last 10 years, which is developers have been a fantastic secular driving force for the implementation of payments all across the web in all sorts of places. How did you think about attracting developers and growing that community and getting adoption of the tool?
Yeah, that's a good question. I think that the whole concept of developer community in issuing processing has changed considerably. We worked with, I would say, kind of a generation of companies that were less sophisticated. If you look at the financial services or fintech broadly today, you have a lot of organizations that are tech centric. And so they want to consume APIs. They have the ability to utilize them, across the ecosystem for whatever application and service that they're building. That wasn't as widespread during the 2010s as it is today. And so, the way we looked at it was, I would describe it more as distributed development than really developer communities, where in some cases your clients were sophisticated enough that they wanted to do some of that development themselves. Blackhawk was a good example of that. But today you've got, the ability for people to create companies that are technology focused, plugging some gap or thinking opportunistically about some new type of consumer proposition, that are starting as technology companies that are going out able to very quickly fire up their businesses because so much functionality is available to them essentially as developers. So I think, getting back to the whole concept of like what's changed between then and now, I think this is another one of those areas where it's kind of a two-sided thing. There's more of an API ecosystem out there because there are more developers able to use it. And as I think about the last 10 years of disruption in fintech, even though there's still a long way to go in terms of how newer products scale and the size of the customer bases, probably one of the biggest changes is this kind of infrastructure layer that has emerged that allows that to happen at a far more accelerated pace than almost the clunky way that it was happening before, of complex agreements and long sales cycles and things like that in order to get people working together. A lot of that friction has been removed. And I think that removal of that friction has really facilitated this notion of like widespread developer communities.
Yeah, and I'm drawing out this thread here. I don't know if it's right or not, but I'm giving it a shot, which is you've spent more recently your entrepreneurial efforts around the fintech community and fintech conferences with Money2020 and Fintech Meetup and others. And it strikes me that there's a core realization about the time that we're living in now, where some of the barriers that used to be a competitive advantage, if you could crunch through how the tech works, or if you could develop relationships with the large financial institutions or the card networks and use that as defense, or if you had capital that others didn't have access to, those were real barriers. And I feel that we're now in a world where, with fintech becoming a venture bingo word and so incredibly valuable for many different companies, those advantages are eroded. And what the competition's really around these days is attention, human attention, the ability to capture the imagination of some particular group of people and direct their energy towards something. And so whether it's comparing Elon Musk's strategy to be the world's richest Twitter man versus Warren Buffett's strategy, or whether it is comparing what happened with GameStop versus the, let's say, more rigorous financial analysis that a hedge fund does that in the end didn't matter. It's clear on display how much social capital and community formation and engagement and sort of authenticity matter. And so, sort of a leading question, but maybe just to get your broad reaction for how you see the value of these communities, whether developer or consumer or investor, where you see that going, and then how that overlaps with some of the entrepreneurial choices you've made more recently.
Yeah, thanks for that. So, it's interesting. If I were to go back 10 years, it's been exactly 10 years, almost to the day that I remember having the idea for Money 2020 and why we needed it. The reason behind starting Money 2020 was that first, call it, a dozen years that I spent in fintech felt like the only real opportunities that were available were long tail opportunities, either because the internet was new and so acquiring was new, or these new use cases for issuing, or maybe it was taking some paper based payment system and making it electronic. Those were the kinds of opportunities that people had in fintech during that first dozen years that I was in it. I felt that starting to change post financial crisis. The government stepped in, created the CFPB, Dodd-Frank. That was clearly a movement towards, some of these barriers to entry being looked at more skeptically and with greater cynicism, that maybe they're not a benefit for the industry. Maybe they've actually stood in the way of innovation that would be really helpful, systemically. So the concept behind Money 2020 was, if it is true that we are now going to be able to innovate at the head of the demand curve, then we need to interact with each other in a very different way than we have across all stakeholders. So, taking almost that example of constructing value chains that I talked about before and applying it across the entire ecosystem, where everybody is willing to say, we need to relook at how we work together, who we partner with, how we think about technology. The primary concept behind Money 2020 was, how do you bring everyone together and build that social capital? You need that interconnected set of relationships among everyone, and you need, trust. So you need kind of this social capital to emerge for a community if they're going to start working together in these fundamentally different ways. And that's in terms of, the products evolving, new companies being created, new individuals entering the industry from tech and other areas that haven't historically been in it. The established players being willing to modernize not only their technology, but their fundamentally the proposition to the end user, which I think is a big driver in all of fintech. But ultimately, it's still a business that comes down to people and trust. And so the basic concept behind Money 2020, again, was just really bring that community together, lead the narrative around this kind of new way that innovation is happening. And so I would say, yeah, it was ultimately, an event, but I would say the intent was to be more than that. It was really to be this community and a catalyst for that community. And as I think about what I'm doing now, 10 years later, in some respects, it's the same. But I think, there have been some pretty significant changes. I think in the last 12 months, we've seen the way that social capital is realized really change. It's gone from, being in the way it was, obviously events being a big part of it, to thought leadership coming from amazing Substack newsletters like yours, frankly, great Slack channels, social media, particularly Twitter, the degree of activity there. And, the whole concept behind FinTech Meetup is, how can we build social capital for this industry, given how important it is and how much it can serve as a catalyst through, face-to-face synchronous communication. There's lots of different ways people can interact, but face-to-face interacting with each other, whether that's online or offline, is something that the industry's been missing now for a year. We're going to start online with an event that we have in June to bring over 1,000 people together. In fact, we're pretty close to 1,000 people signed up right now to have, upwards of 10,000 one-to-one meetings, so we can continue to, help the industry build that social capital. And then after June, we'll see. Do we take that offline? Let's see how things shape up with the pandemic. Let's see what the industry needs. Do we start building subsets of communities and marketplaces? That all remains to be seen. But this kind of latest iteration of my career has been going from being an operator, building fintech, to really being someone more focused on community and interaction and how that can serve as a catalyst for others to do that.
Yeah, super interesting and really compelling. And I think we'll see how things go. But I feel that social capital is actually on a path to be, maybe in a dystopian way, almost financialized, securitized, and connected into markets as well. So in 10 years from now, I feel that we might be in yet another strange version of the world where our attention and our money converges even one step further.
For sure.
Anil, thank you so much for your time. Fascinating conversation. I really appreciate it.
Thanks so much for having me. I've really enjoyed it.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.